The stampede out of equities into bonds has dropped the U.S. 10-year Treasury to a record low as investors shun stocks for safety. Yet several U.S. stocks have attractive dividend yields and look like great value plays. In other words, investors should be looking to buy Big Macs, not U.S. debt.
Does McDonald's continue to make money? Do they continue to increase revenues, increase earnings? So that implied dividend yield, or the dividend they're going to pay quarterly, is a good cash flow that's coming in, and it's a lot better. You're a lot better off in McDonald's today than you are in buying the U.S. government Treasury.
The objective of the Neiman Large Cap Value Fund is to do better in down markets while capturing a substantial amount of upside. Performance has been steady thanks to a combination of gains on stocks sold, premiums from selling covered call options, and perhaps most importantly, dividends.
Large cap value stocks that pay good dividends will be here for a long time, assuming companies continue to make money, and as we've seen, earnings continue to sort of beat estimates. The dividend play can help sort of buoy the ups and downs of the markets, reduce volatility.
To find stocks for the mutual fund, Neiman looks for companies with low debt to equity, solid price to earnings and price to book ratios, cash flows, and impressive 5-year growth in revenue and earnings. Beyond that, he wants companies that pay a dividend and prove they can increase that dividend over time.
Put all that together and you find a nice broad range of companies across all industries that lets you have a diversified portfolio within this sort of strict discipline style.
To lower risk and volatility, Neiman has looked at 3 sectors: energy, transports, and consumer staples. The energy sector in particular has shown value and opportunity.
The one stock that we like right now is Occidental Petroleum. It's around a 2% yield, not necessarily the highest yielding stock in our fund, and we see a good value buy right now in Occidental. It being down year to date, we feel like it's a good hold for us in our fund.
As a value investor, Neiman says he sees railways as another source of both income and value. In particular, he is a fan of Norfolk Southern.
You add the yields we've been talking about, good dividend yields across a lot of transportation stocks, but it's specifically the rails and specifically Norfolk Southern. We feel it's a good company to own.
Neiman also likes consumer staples, specifically tobacco stocks that have proven they can outperform in a down market and a recession. He likes 2 high-yielding names, Altria and Philip Morris.
We feel that the 2 stocks themselves are actually good, not only good buys, but good holds for a dividend portfolio.